They told you $65 was an unbreakable ceiling. They promised the banks would crush silver the moment it got closed. Today, that ceiling collapsed. And what's unfolding now is far more dangerous than the breakout itself. The barrier that defined this market for months no longer exists. For a very long time, the financial world spoke with one voice about silver. $65, they said, was the maximum. It was treated as a hard boundary, a price that would never be allowed to stand. Analysts repeated it endlessly. Commentators explained how banks had defended this level for years and would continue to do so with unlimited paper supply. The message was clear. Silver could approach 65, but it would never survive above it. That confidence vanished on Wednesday, December 17th, when the market delivered a verdict no one controlling the narrative wanted. Silver did not hesitate or pause politely at resistance. It tore through 65 with speed and violence, as if the level barely existed. In a matter of hours, price surged to roughly $650, stunning traders who had grown accustomed to watching every rally die at the same familiar ceiling. As these words are being spoken, silver has eased back slightly and is trading near $65.80. That modest pullback has already unsettled many people watching the chart, creating the same doubt that appears after every sharp move. If you're staring at that retracement right now, you're probably feeling a familiar discomfort. You see the price backing off from the highs, and your mind immediately jumps to past experiences. You start wondering whether this was just another engineered move, another temporary spike designed to lure buyers before collapsing. That emotional response is natural, but it is also precisely what this market exploits. Because what we are witnessing is not a failure, not a breakdown, and not the end of the move. It is something far more constructive. What we are seeing is a retest. This is a critical phase that separates real breakouts from false ones. In this market update, we are going to unpack exactly what happened, why silver moved so aggressively in such a short window, and why this pause around $65.80 is not only normal, but essential. We will walk through the mechanical forces behind the surge, including the options-driven gamma feedback loop that forced banks to buy silver whether they wanted to or not. Most importantly, we will explain why defending this level now matters more than the initial spike ever did. Markets that move straight up without interruption do not sustain those gains. Vertical price action without structure almost always collapses under its own weight. A pause, a pullback, and a test of the newly broken level are what transform chaos into trend. The wall at 65 has fallen. The market is now asking a simple question: can the rubble support the next advance? To understand why silver seemed to jump from the low 60s into the mid-60s almost instantly, you need to look beneath the surface. You need to understand how modern markets actually function. The answer lies in a concept most retail investors never hear about: gamma. Gamma is an options-related measure that tracks how quickly risk changes for a market maker as price moves. Market makers function like casinos. They sell bets, collect premiums, and rely on probability and structure to remain profitable. In silver, they sold enormous volumes of call options at the 65 strike. These contracts pay out if silver rises above that price. As long as silver remained below 65, those options expired worthless. The banks collected premiums, and the system remained stable. The instant silver crossed 65, the risk profile flipped. Losses did not increase gradually, they accelerated. At 65.10, internal risk models began flashing warnings. Algorithms designed to protect banks from runaway losses automatically started buying silver futures to hedge exposure. This buying had nothing to do with belief in silver or confidence in fundamentals. It was math enforcing discipline. As those hedges were placed, price rose further to 65.30, then higher. That rise increased risk again, triggering more forced buying. The loop fed on itself. This is what defines a gamma squeeze, a self-reinforcing cycle, where buying begets more buying, independent of sentiment or supply narratives. We saw this exact mechanism in 2021 when heavily shorted equities exploded upward. Today, the same mathematics turned against silver suppressors. The spike to 66.50 was not enthusiasm. It was algorithmic panic. Liquidity vanished, sellers stepped aside, and machines competed to cover exposure at any available price. The market briefly entered a vacuum where price moved faster than human reaction. Then it stopped. The move paused because humans stepped back into the process. Once the forced hedging ran its course, discretionary traders began locking in gains. The emergency buying subsided and price drifted lower. That pullback did not undo the breakout. It confirmed it. The damage to the 65 ceiling had already been done. Now, let's focus on where we are. Around 65.80. To someone unfamiliar with market structure, that looks like weakness. To anyone who understands price behavior, it looks like validation. There is a foundational principle in technical analysis that has survived every market cycle. Former resistance becomes future support. For months, 65 rejected price repeatedly. It acted as a roof. Today, price smashed through that roof. Now, the market is standing on top of it, testing whether it can hold. This pullback is the test. If buyers continue to defend this level and price holds above 65 into the daily close, the breakout becomes structurally real. That level stops being a selling zone and becomes an accumulation zone. But this is not the time for celebration. This is the most delicate moment of the move. If silver fails to hold 65 and closes meaningfully below it, the breakout risks being labeled false. False breakouts often unwind sharply and violently. Right now, the market sits in a narrow buffer. Roughly 80 cents separates confirmation from rejection. This is the battlefield, and something very important has already revealed itself here. Recall the large buyer that absorbed massive quantities of silver around 63 not long ago. Many speculated that this entity would sell into strength once price spiked. But watching today's order flow tells a different story. As price retreated from 66.50 towards 65.80, large block bids appeared beneath the market. Someone stepped in decisively near 65.75 and absorbed selling pressure without hesitation. That behavior speaks volumes. Last week, this buyer viewed 63 as attractive. Today, they are willing to defend 65. That is not how short-term speculators behave. Speculators distribute into strength. Strategic buyers accumulate into weakness. This buyer is not exiting. They are reinforcing the floor. Why would they do that? Because they understand what holding this level unlocks. If 65 remains intact, the market's focus shifts rapidly. 70 enters the conversation not as a dream, but as a visible target. Beyond that, 80 plus becomes mathematically plausible. This buyer is not chasing headlines or momentum. They are securing territory, building a base from which the next advance can launch. When you see consolidation at 65.80, you are not witnessing loss, you are witnessing preparation. The gamma squeeze lit the fuse. The retest provides stability. But the sustained fire comes from a different source, entirely short sellers. For decades, commercial banks have controlled the silver market by maintaining enormous short positions. They sold paper silver aggressively, leaning on price whenever it threatened to rise too far. This strategy worked for years because the system allowed unlimited paper creation. But every strategy fails eventually. At 66.50, losses stopped being manageable and started becoming existential. This is where short covering enters the picture. There are growing, persistent reports, still unofficial, that at least one major commercial institution began reducing short exposure during this move. While confirmation will take time, the market's behavior aligns with that possibility. And if even one large bank is forced to cover, the implications extend far beyond a single trading day. To understand why, we must examine the scale of the position. Commercial traders currently hold a net short position of roughly 80,000 silver contracts. Each contract represents 5,000 ounces. That equals approximately 400 million ounces of silver sold short, silver that largely does not exist in physical form. Those positions were built at much lower prices. 50, 55, levels that now feel distant. At 60, 580, every one of those contracts is underwater. This is the definition of a trap. When you are long, the worst case outcome is losing your investment. When you are short, there is no ceiling on loss. If silver moves to 100, 200, or higher, the liability grows without limit. At these levels, risk managers do not debate philosophy. They react to numbers. Exposure that threatens earnings, capital ratios, and regulatory scrutiny forces behavior to change. Historically, banks responded to rising silver prices by adding more shorts to cap rallies. This time, they cannot. Margin requirements expand. Credit lines tighten. Instead of pressing the market lower, they are forced to retreat. Retreat means buying. A short seller buying to close does not care about valuation or timing. They care about survival. They become an aggressive, price-insensitive buyer competing with industrial users, strategic investors, and large accumulators. That buying creates a powerful bid beneath the market, absorbing dips and preventing sharp declines. This is why 65.80 is holding. Short covering is quietly feeding demand into every pullback. Let's put real numbers to the pain. For every $1 rise in silver, the commercial short position loses roughly $400 million. From 60 to 66, losses approach $2.4 billion on paper. And that figure assumes they can exit cleanly at current prices, which is unrealistic. If banks attempted to cover hundreds of millions of ounces in a market already facing physical stress, price would explode. Slippage would multiply losses dramatically. The true exposure is not a few $billion, it is potentially many times that. This is why 65 mattered so much. Above it, losses become visible. Above it, uncomfortable questions are asked. We are watching institutions attempt a controlled exit from an uncontrollable situation. They want to reduce exposure quietly, gradually, without drawing attention. But the presence of large buyers beneath the market makes that nearly impossible. Every ounce offered is absorbed. Every dip is met with demand. That forces higher bids, accelerating the squeeze. This dynamic can be confirmed by watching open interest. In a normal rally, price rises alongside open interest as new positions are added. In a short squeeze, price rises while open interest falls, signaling that shorts are closing and leaving the market. When updated data is released, this will be the key metric to monitor. That said, banks under pressure often attempt one final maneuver. A sudden paper dump during thin trading hours can still occur, designed to trigger panic and shake out weak hands. If you see a sharp, overnight drop, do not confuse noise with trend. Unless silver decisively breaks back into the low 60s, the structure remains intact. Capitulation is rarely clean. It unfolds in stages. While Wall Street struggles with paper exposure, the physical market is already sending a much clearer message. The move we witnessed today was not driven by financial mechanics alone. It was fueled by real-world urgency. Away from trading screens, industrial buyers are facing supply stress, and their actions reveal the truth about silver's real value. The number you see on a screen represents a promise to deliver metal at some future date. In the real world, reliability matters more than price. Factories cannot stop. Solar manufacturers cannot pause production. Electronics makers cannot afford delays. If silver paste runs out, losses mount quickly. In that environment, paying $70 or more per ounce becomes trivial compared to the cost of downtime. This is the shadow price of silver, the price paid quietly to ensure delivery. It does not appear on exchange tickers, but it governs real decisions. It is the price that keeps assembly lines moving and contracts fulfilled. And it is already diverging sharply from paper quotes. This divergence creates an unstable situation. Paper silver trades at one level. Physical silver trades at another. Volume shifts off exchange, draining inventory, while the paper market maintains the illusion of balance. Eventually, the illusion breaks. When exchanges cannot deliver metal at posted prices, price must adjust upward rapidly. Retail markets reflect this stress clearly. Premiums are rising even as spot consolidates. Dealers are hesitant to sell inventory they cannot replace. Many push customers into pre-orders, signaling uncertainty about future supply. This is not bullish enthusiasm, it is risk management. For paper holders, the danger is greater still. Many contracts allow for cash settlement in the event of disruption. If physical silver trades at 70 while paper trades at 65, issuers will choose cash. That decision saves them money but destroys trust. Cash recipients rush to acquire physical metal, driving premiums higher and accelerating shortages. This feedback loop has begun. Technically, structurally, and physically, silver has entered a new phase. The only remaining obstacle is psychological. Volatility will increase. Headlines will grow more dramatic. Price swings will test conviction. This is where most participants fail, not because they were wrong, but because they act too soon. Silver is not merely rising. Fiat currency is eroding. The metal reflects that decay. Selling now to retreat into depreciating cash is not safety, it is surrender. History provides perspective. Adjusted for inflation, silver remains far below prior highs. What appears expensive nominally is cheap in real terms. Other asset classes trade at extremes. Silver does not. The true exit strategy is not liquidation into currency. It is conversion into undervalued assets when ratios normalize gold, land, productive resources. Wealth is preserved through swapping, not selling. December 17th will be remembered, not as a spike, but as a transition. The day suppression cracked. The day price discovery began. The day the ceiling failed. You are already positioned. The hardest task now is restraint. Hold steady.